Well, let's take a look at shares of Bank of Nova Scotia. The bank, reported a second quarter profit that narrowly missed expectations. There's the stock up 1.5 percentage points. Loan losses were a story. Certainly provisions for expected loan losses were a story. The impact of tariffs weighed on the bank's Canadian business and perhaps its Mexican operations as well. Let's get perspective from our first guest of this hour. Kyle Taylor is wealth advisor and portfolio manager at TriDelta Private Wealth. Kyle, thanks a lot for coming in.
Thank you. What's
your take on these numbers? The analyst takeaway is pretty clear here, that this was only a narrow earnings miss, and the degree to which Scotia missed expectations was a function of its decision to take a provision not only on expected credit losses, but on performing loans, to cover loans that are still up to date, but the company has some concerns about.
Yeah, the elevated loan loss provisions were largely expected. They came in at $1.4 billion, up from $1 billion this time last year. It seems like today the big focus is on that narrow miss and the fact that all banks are reporting higher loan provisions, and the fact that they increased their dividends and will be buying back 20 million shares, which was received pretty favorably by investors.
What about the dividend hike? Was it what you expected? It was not a big hike.
Yeah,
about 4%.
We were expecting about 6%.
Right.
They raised the quarterly dividend 4 cents to $1.10 a share, so relatively in line.
So Scott Thomson is not a new CEO anymore. He's been there for more than 2 years. He is to some degree refocusing the bank on North America, to some degree refocusing it away from Latin America, which is the big differentiator between the other banks and this one. What do you think of that strategy?
Well, they're really Bank of Nova Scotia is really the main international bank in Canada. About 40% of their profits is derived from primarily Latin America, as you said. And he has made this push towards more North America. I think the push towards more in the Canadian market is being well received by investors, given the higher margins, possibility for cross-selling. You had the U.S. acquisition of the 15% stake in KeyCorp, the U.S. regional bank, late last year. Sort of getting their feet in the water with the U.S. And really, I think the one maybe drawback that investors are seeing is on Mexico and the expansion there right now and away from some of the other primary markets in Colombia, Peru, and Chile. And a lot of that has to do with the fact that although there is some cross-border opportunities for the U.S. and Canada, there is the drawback of the tariff uncertainty and the implications for Mexico on that front.
That's my next question. How should investors be thinking about Bank of Nova Scotia's significant presence in Mexico? I think it's the number 2 bank in Mexico, and tariffs. And the reason I ask that question is that in its credit risk section of its results, it says this. Here's an exact quote. The increase in provisions for credit losses reflects the continued uncertainty related to U.S. tariffs, mainly impacting the Canadian retail and commercial portfolios. Absent from that sentence is any reference to Mexico and the effect that tariffs might have on that economy and therefore Scotia's prospects there.
Yeah, the increased credit costs in Mexico or in North America really isn't anything new, unfortunately. It's something that's held the stock back, in my opinion, for some time now. The other aspect of the Mexican operations is it is a higher, or should be a higher margin business for them. So if well executed, it can be an opportunity for the shares.
The thinking on the Latin American markets has always been they're higher risk markets, but they're higher return markets as well, high reward markets when those economies are growing. Emerging market economies often grow at much faster rates than do established, developed economies.
I mean, you could even look at it from the diversification standpoint of the bank revenues. One of the concerns right now is on the housing sector for Canadian consumers, Canadian banks. And if you look at Bank of Nova Scotia, they have the least exposure of any of the big 6 banks in the Canadian housing market. So that could be, some insulation for them if there is a downturn in Canada.
Okay, what do you think of the share price of Scotia?
Well, we have a price target about $79 a share. You see that they're up today. I mentioned some of the rationale behind that. I think there's an opportunity in the shares, but it's not something that we're really jumping on right now at current levels.
And what do you think of the group at large, the Canadian bank stocks at large, which have had quite a rally? So has the broader stock market, of course, but have had quite a rally since early April.
Well, the big bank cohort, they're trading at about 12 times forward earnings today, which is at the high end of their, call it 10 to 12 forward earnings range historically. Really, we see the outperformers as Royal Bank, TD, and Imperial. Royal and Imperial probably have the highest expectations going into their earnings reports. So with that does come some added risk if they underreport. But we saw TD have a pretty favorable earnings report, less loan loss provisions than expected, and some job cuts that were well received pretty favorably.
What kind of weighting do you have on behalf of clients in Canadian banking generally?
I would say it's been elevated the last 6 to 12 months, but it's not something that we're overweight today. I think we're finding some really great opportunities in North America elsewhere as well.
That's Kyle Taylor on one of the big Canadian stories of the day so far, results from Bank of Nova Scotia being applauded by investors